Boy, there's a lot going on in the world at the moment, isn't there? Overseas, there's all the geopolitical issues. Back home, we've got our own political issues, plus concerns about wages growth, inflation, the economy, the effects of the flood. Now, of course, Australia's economy and our property markets don't operate in isolation, and that's why each month I take time out to have a look at the big picture, the macroeconomic factors affecting not just Australia's economy, but the world economy, to help us better understand what's likely to be happening ahead for us. And I do that each month in these Big Picture podcasts with Pete Wargent. Now, while regular listeners will know Pete well, if you're new to the podcast, well, firstly, welcome, because I can see that there's thousands of new listeners every month. But the reason I'm keen to discuss these matters with Pete is not because of his academic credentials as a chartered accountant, chartered secretary, because he's got a financial planning diploma, but I enjoy these chats because of the credible perspective Pete brings on what's happening around the world as an international investor and as a business person. And boy, there's been a lot happening since I last spoke with Pete, so I'm sure you're going to get a lot out of the show. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Look, with a couple of months' data under our belt now, the Australian property market's starting to show its true colours for 2022. But is it going to be interrupted by all the problems happening overseas and locally? What's ahead? What's the rest of 2022 going to bring? There's some of the topics I'm going to be discussing in this month's Big Picture podcast with economic analyst Pete Wargent, who's a lifelong student of and commentator of our economy. Hello, Pete.
Hi, Michael. Lots to talk about.
There is, isn't there? Now, at the time of recording, which will be a couple of weeks before this actually goes live to air, there's still problems overseas, and it would be wrong not to discuss what the fallout you think is going to be with the economic and political world when the war with Russia and Ukraine's over.
Yeah, so at the time of speaking or recording, as you said, a lot of the world has been imposing sanctions on Russia. So this will have severe consequences for the Russian economy, but probably more severe for Russia than for the rest of the world. Huge humanitarian issues, refugee crisis at the human level. In terms of the economy, well, the oil prices spiked, so that's over $100 a barrel. And gas prices also spiked initially, a huge jump in gas prices of about 70%. So I guess in terms of what that means around the world, well, inflation, rising energy bills. I think in terms of the longer term changes, well, I guess we'll be reducing our dependence on Russia's fossil fuels. But it's an ongoing challenge, right, for policymakers. There's a risk that this initial sort of spike of inflation becomes embedded and people sort of see inflation sticking around for longer. So in terms of monetary policy around the world, it's a challenge. And I think maybe as well, there'll be more spending on defence, which isn't a bad thing economically, except that it diverts money away from things like education and healthcare and infrastructure. The main issue economically is going to hit Russia first and foremost. So hopefully we'll get a quick resolution to the conflict, of course. Yeah, I guess at the time of recording, it's very unclear.
Isn't it? And similarly, as a resident of Queensland, I don't have to tell you there's been some dramatic flooding in Queensland. It then moved down to northern New South Wales. And of course, in the medium term, our focus has got to be on the safety of the people there, the rebuilding. Those images are terrible as you see what's happened to people's homes, people's businesses. But I know that recently you put out a press release about what happened last time round. Some of our memories are a little bit short. I do remember the floods of 2011 and how it affected various elements of the Brisbane property market. What are your thoughts about moving forward and what's going to happen to Brisbane property related to the floods?
Yeah, you're right. So the initial focus is obviously on the cleanup, and then attention will turn to things like repairs and then insurance claims. In terms of the market, well, as you mentioned, in 2011, it was a slightly different dynamic going into the flood period, because the market was pretty flat anyway. We'd had a boom up until the global financial crisis. But the flood impacted areas over the following 5 years, house prices actually outperformed in 19 of the top 20 most flood impacted areas. I think Brisbane house prices did about 26 or 27% over the following 5 years. And almost all of the suburbs, except for Pinkenba, which is essentially just airport land, comfortably outperformed the growth. So things will probably snap back quite quickly for the housing market. I guess in terms of why that's the case, partly because they're often riverside suburbs, which are quite highly sought after, places like New Farm or Hawthorne and so on. Also, I think people see the opportunity maybe for a bargain, but also sometimes those areas are appropriate for developers as well, so that makes them somewhat attractive. But generally, yeah, people do tend to recover quicker than you might expect. And I think we'll probably see the same this time around. But of course, the initial focus is just on getting back to normal.
Very much so. Now, I know you don't focus on those areas which are more likely to be flood affected or even stormwater affected, even if they're not near the river. And we at Metropole don't either. But Brisbane really has been the shining light of the property market last year and is likely to continue on this year. But I think it also makes investors aware of climate change and insurance risk, because some areas are going to be much harder, much more expensive to insure with regard to the floods. Other areas are going to be cyclone affected higher up in northern Queensland, and some areas are going to be almost uninsurable with regard to fire and flood and acts of God in the future, Pete.
Yeah, so in some of those flood-prone areas and low-lying land, insurance premiums are already pretty high. Now, Brisbane City Council, to its credit, has been very good in terms of providing flood risk mapping and floodwise reports and so on for buyers. So there is transparency, but it's an annual headache paying the insurance premium in some of those locations. And that was the case even before this round of flooding. So I expect it'll be worse going forward. So yes, it's definitely a risk, especially I think for people who are interstate. They don't really want that sort of headache in their life, or the sleep at night factor of just worrying about what might happen down the track. So yeah, it does have an impact, particularly on things like insurance. So yes, like we're based at Noosa and we dodged the worst of it, but places like Lismore, Brisbane, Gympie have been hit pretty hard.
Terrible. Sure. Turning to something different, there's been a lot of talk about the Great Resignation overseas and is it going to happen in Australia? And I was interested to read a recent National Australia Bank survey which showed that 1 in 5 working Australians changed jobs in the past year. That's 20% of Australians. And a large number indicated that they were considering leaving their job when they asked to do so. Almost a quarter said they were thinking of leaving their job. Gee, this is, I think, one of the interesting after effects of COVID. Others thought that they weren't going to leave their job, but just keep up to date with job opportunities. And of course, it did make a difference in different age groups. A greater share of full-time workers are considering leaving their jobs over the next 12 months, 24% compared to 18% of part-time workers. And by age, younger workers were more likely to consider changing jobs. I don't know, is it just that the Gen Xers are not as able to stay in the one place the whole time, or is the world changing?
There's definitely a bit of that. I think the Great Resignation, as a sort of a meme, if you like, that it was really came from overseas, and maybe in Australia it's not quite as dramatic, but I think there is still an element of that sort of disruption in the labour market. A lot of people working from home, of course, at the moment and not going into the office, which probably has accelerated some of the change. But overall, I mean, the jobs market is in pretty good nick. Job vacancies are,
aren't they?
Nearly a record highs. The unemployment rate's under 4.5% and probably heading into the threes. So we'll be talking about full employment again pretty soon. And in some sectors of the economy, there are skills shortages and wages just starting to rise in some parts of the economy. And of course, the borders are now reopening. So at least, there's going to be skills coming in. I think actually, just thinking back to what you were talking about before, in Brisbane, I think one of the housing market impacts is going to be on the rental market, because
yes,
we've got a big surge of immigrants coming in to fill these skill shortages. But where's everyone going to live? There's already a shortage of rental properties. We've got flooding around half of Queensland at the moment. So I think there's going to be a chronic amount of pressure in the housing market, but particularly on rentals.
Well, there's also going to be an upward push on building costs. There's already a shortage of tradespeople. There's a shortage of builders, shortage of materials, and there's now all of a sudden going to be a huge extra requirement for all of those sort of things. That's going to push up building costs, which in the long term are good for the property market because anything new being built is going to cost a lot more, but it's going to make life difficult for people in the short term.
Yeah, and in fact, we've seen just in the past week at the time of recording, ProBuild has gone into administration. There's a lot of units under construction that just won't be finished now. I think about 2,500 or so around Melbourne and Victoria. Also big developments in Brisbane on Queen Street, the Ribbon at Darling Harbour. So there's a lot of stuff that's under construction that won't be finished anytime soon. The challenge for the industry is that quite often these projects are built on fixed price contracts and the price of materials has gone rocketing higher. As you mentioned, it's difficult to get trades and labour. ProBuild has gone into administration, but as they say in Queensland, there's never only one cockroach. So you can probably expect more insolvencies in the construction sector. So again, I think it's going to be a theme of the housing market this decade is just a shortage of properties because unlike 7 or 8 years ago, we're just not seeing the big tower blocks being built anymore. I think partly or largely because of the absence of Chinese investors this time around.
And it's not just the big builders like ProBuild, which is owned by a South African entity, but also small builders who are going to have difficulty as they've entered contracts to build homes for mums and dads, their first homes often, and the costs have gone up and they're stuck in a contract that's now unviable, and the small builders are going to have even more difficulty remaining financially viable. So that's going to have a bit of a spin-off effect as well. You're right. Of course, there's a new trend coming, though, that while there aren't many apartments happening yet, large institutions, Australian and overseas, are looking at the build to rent market where they're going to build whole apartment blocks purely to rent and for them to keep in the long term rather than sell them off to investors. They're buying the sites at the moment, Pete, and they're tending to be in the same sort of locations where previously developers were building for the overseas investors, in the high density locations, because that's where it's more viable to build them.
Yes, in fact, I think I'm right in saying that ProBuild actually had some build-to-rent developments under construction that won't be finished anytime in the near future. Look, I'm not really a big fan, I have to say, of the build-to-rent sector. We've seen a lot of it in London over recent years. And yeah, look, it doesn't always live up to the tag, if you like, in terms of the quality of the experience for the tenants. Because I suppose at the end of the day, the institutions are there to make a profit. I think initially the buildings can be good, but the incentive to keep up with things like repairs isn't always top notch. And I think that there's just generally a risk of the tenants becoming another number in the system rather than being dealt with as a person or, a family renting a property. It's a lot more widespread in London than it has been in Australia. Whether or not it will be successful in Australia, I don't know. But I suppose at the end of the day, these are not, in the scheme of a housing market of 10.5 million dwellings, it's not really that much going to move the needle, I suppose. The numbers just aren't that big.
No, other than if you own an off-the-plan property in one of the adjoining buildings, but one of those other big towers, and therefore your own investment becomes even less scarce and has more competition. So again, a reason why I know neither you or I like the idea of investing in those Legoland high-rise towers that have in the past been built out of paper mache and are still going to have lots of structural issues. Now, a big picture podcast, if we do once a month, Pete, wouldn't be the same if we didn't talk about interest rates. And what's been happening up to now is the Reserve Bank's been saying we're waiting for wages to go up. They're wanting the economy to do well, inflation to start increasing, and that's happened, and wages to increase. And currently, the latest wages data shows that real wages, in other words, wages after inflation, have fallen a bit. But only recently in the March statement, the Reserve Bank governor's maybe having a slightly different view on what he means by wages growth.
Yeah, so if you look at the wage price index, wages growth was only 2.3%. over the year. So pretty low. If you include bonuses, then it might be nearer to 3. But as you mentioned, there are different ways to measure this because, as you alluded to before, there's different ways in which people get pay rises. You can get a pay rise in your existing job, but quite often what people do is they upskill or they move to a higher paying role in a different industry. So there's different ways that households can actually increase their income. It doesn't always come from an employer giving you a pay rise. And in fact, in the public sector, pay rises have been very, very low, under 2% recently. So look, there is some evidence of wages going up in some sectors, but not really broad-based at the moment. So the Reserve Bank is being patient. And I guess if you take what they say at face value, there's no real evidence they're going to hike interest rates anytime soon. But I think financial markets think in the second half of 2022, as things start to open up and the economy really gets moving, then we might actually start to see rate hikes, which has already happened in New Zealand. I think the thing is, I just don't think we'll see high interest rates. We might see a hike or two, but whether or not we get far away from zero, that's a different question.
Well, clearly interest rates are low at the moment. They're stimulatory because the Reserve Bank wants to grease the wheels of industry. It's wanting us to buy properties, to spend money, businesses to invest. And it's only when they're going to want to slow things down a bit, they're going to bring them back from stimulatory to neutral. But they're not going to necessarily make them so high that they're going to stifle the economy. That's not what the Reserve Bank wants. But what are neutral interest rates? I think a lot of the economists are going back to the old textbooks of what neutral interest rates were a while ago. But today, with many Australians being more indebted, it probably won't take as many interest rate rises or as large interest rate rises to slow the market down. And if that's the case, all those predictions of, 10, 15% property falls next year, they're not as likely to happen in my mind, Pete.
No, so yes, you're right. In terms of the jargon, the neutral rate is essentially the cash rate that would bring about full employment and stable inflation over the medium term. Now, the Reserve Bank has said previously that the neutral interest rate should be, in nominal terms, between 2.5% and 3.5%. So the cash rate is currently 0.1. So the implication of that is essentially 250 basis points or 2.5% to get back to neutral rather than where we're at the moment, which is an expansionary policy. It sounds optimistic to me. We would really need to see much stronger wages growth, I think, for the neutral cash rate to be as high as 2.5% or 3.5%. It feels like, and this is not an exact science, but it feels more like 1.5% might be the reality. Now, where's the potential inflation? Rents we mentioned, energy, things like petrol prices and food at the moment, and that won't be helped by the flooding. But across the whole economy, there isn't really that much happening in terms of inflation. It's not an exact science. The Reserve Bank has said previously a bit higher, but I'd be personally surprised if this cycle we see the cash rate rising that high. So we'll just have to wait and see. But in terms of what it means for the housing market, is a 1% cash rate really going to have that much of an impact? I don't think so.
Anyone who's borrowed over the last couple of years has had to at least factor in a buffer of 2% and more recently 3% in their lending criteria. But I was interested not that long ago to read the National Australia Bank CEO suggesting he can't see mortgage stress occurring with rate price increases anytime soon. A lot of Australians have paid down their mortgages. They're a number of months ahead. They've got cash stashed away. They're wealthier than they ever have been. They've got more equity in their properties. Interest rates are only going to go up when wages go up, and similarly rents. I mean, we've already spoken about that a couple of times this morning, that rents are going to go up over the next year, just a supply and demand factor. So I think one has to take it into account in one's planning, but not be worried by these Armageddon forecasts by the same people who thought property values were going to crash in 2020.
No, I mean, what causes mortgage stress? The biggest factor is unemployment. And the unemployment rate is heading to 3% or somewhere around that level. So effectively full employment. We haven't seen anything like it since the mining boom. And we could see the lowest unemployment rate in half a century. So it's not coming from there. As you mentioned, new borrowers are stress tested with a 3% buffer. So mortgage stress isn't coming from there. I think sometimes where people could get into trouble, particularly highly indebted portfolio investors, But as you mentioned, we've seen the lowest vacancy rates in over 15 years. I think rents will rise 10 to 20% this year. I think generally landlords will be well placed to absorb rising rates. And people who've been in the market for a long time, of course, have seen the cash rate go from 7 to 0. So they're not going to be stressed in any way, shape, or form. So I think actually, given the sort of position and the state of the labour force, that the economy, I think generally people are pretty well placed to absorb a few interest rate hikes. And as you mentioned, the doomsday forecasting, well, it's always out there. But I think the thing to remember in the housing market is that the equity there is a stock of wealth. It's not a flow. There's a great deal of wealth in the housing market in terms of equity, and households are sitting on record household savings. So, yeah, sometimes people might just need to sort of sense check some of their modelling.
Well, for the house prices to fall so much, people would have to sell their home, and there's no one there to buy it. And for the reasons you've just said, high employment, increasing wages, financial stability, there's no reason that should happen. And people don't sell their home if they're having a bit of trouble. They'd rather eat Maggi noodles for a while or sell some other assets. It's a bit too hard to sell their home because they've got to move somewhere else as well. Now, one of the other factors that's going to bolster our property markets is population growth. I mean, the tide's turning now. Overseas arrivals have started to come in. It was only a short while ago that the borders have been opened, and we've had, for the first time in a long time, more short-term visitors coming to Australia. What's your take on that?
Yeah, I think, well, clearly there's new arrivals coming in now. International students were able to come in previously. Now from 21st of February, visa holders who have been vaccinated are allowed to come in. So look, overseas arrivals are starting to ramp up again. I suppose the big picture, this is the big picture podcast, is that the population growth rate in Australia has basically been nothing for a couple of years. There's been a natural increase in the population, which is births minus deaths, but there's been no immigration. If you look pre-COVID, we were running at about 1.5%. So that would imply population growth of about 375,000 per annum. So Australia tends to run a high immigration program. So that would sort of suggest natural increase of 150,000 and overseas migration of about 250. So this is a really key point for the housing market, is that despite 2 years of no immigration, essentially, the market's held up just fine. But over the sort of the years towards the middle of this century, well, Melbourne's going to go from sort of 5 to 8 million people. Sydney's going to do the same. So if you're investing in those cities, well, you've got 8 million reasons why the outlook for property is pretty strong. Yeah, it's going to take a bit of time for things to get back to normal, but we've got a 2-year backlog now of people wanting to come to Australia, and it's a very attractive destination in global terms. So we would never have any problem filling a migration program if that's what the policy is intended to do.
Pete, recently the Property Council of Australia has released a new report suggesting that there's going to be 1.7 million new households formed in Australia in the next decade, between now and 2032. And the strongest growth in those new households is expected to be lone person households, 595,000 of those, followed by couples without children, about 500,000 of those, and then couples with children. And on the back of what's still going to be lowish interest rates and federal government stimulus, we're going to need a lot more housing. We've got to place all these people. So if we believe we're going to have a wealthy nation, and we are in a great position compared to many other countries, and there's going to be more of us, that's really going to underpin our property markets moving forward.
I guess with the Housing Industry Association and the Property Council, they nearly always forecast a shortage of property for obvious reasons. But I think even at the headline level, if we are able to build enough dwellings, just in terms of the sheer numbers, that is one part of the equation. But I think it's partly the composition that is the challenge. As I mentioned, vacancy rates are already nearly at the lowest levels in 20 years. And we've got a very strong population pyramid in Australia. So there's a huge number of people in that 25 to 35 age bracket just starting to form households. It's been difficult for investors to get financing over the last 4 or 5 years. So there's a shortage of willing landlords as well. So look, it's partly the composition is the challenge, because we're not building the big apartment towers like we were. Whether people like to hear it or not, the reality is Australia is a wealthy country. And what happens when people get wealthier? Well, they just buy more houses and more properties. During the pandemic, a lot of people bought second homes in coastal regions or regional areas. So even though we have built quite a bit through the home builder package, still there's an undersupply of the types of properties that we need and want. And I think that's going to be the challenge over the next 10 years.
Well, we've discussed a lot this morning, and hopefully next time we get together in a month, the world's going to be a much calmer, safer place. But before we actually press the record button, I was having a chat with you, the fact that I was listening to your podcast, the Pete Wargent Property Pod, on my walk with my dog Lincoln this morning. I look forward to it. It comes out every week. And I know you're gathering a large audience. It's building because you're getting some great guests. So my recommendation to anyone who likes listening to podcasts is go to wherever you're listening to this podcast and they'll find your podcast, Pete. How's it going? Are you enjoying speaking to this wide range of people?
Yes, I guess it lives and dies on the quality of the guests. And we've had some excellent guests. I've had Michael Bevan, the cricketer, last week, and we even had your good self on a couple of weeks back. So, yes, and hopefully Lincoln is also enjoying the Pete Wargent Property Pod.
Fantastic. If people want to get your daily blog, find out about your 2 podcasts or your multiple books, where do they look for you, Pete?
Easiest place, petewargent.com. There's a list of what I get up to there. But my daily blog is Pete Wargent Blogspot, where I just post my daily musings.
Definitely. We republish some of those on Property Update, but it's more than musings. There's lots of charts, but I think more importantly, it's good perspective based on a number of decades of economic, property, share market and business experience. So I look forward to catching up with you again in a month, Pete.
Pleasure. Thanks, Michael.
Well, I hope you now see why I enjoy my monthly chats with Pete Wargent. He brings a great perspective to our podcast. And if you got some benefit from it, please help somebody else who you think would also benefit understanding what's happening around the world and having a different perspective on the economy, our markets and property. Just tell somebody about the Michael Yardney podcast, just one person this week, and that'll do me a real favour, because my aim is to make as many people as financially fluent as possible. Of course, I'd be thrilled if you told the world by leaving a review wherever you listen to this podcast. And I'd also like to say thank you for listening to this podcast, and my way of saying thank you is offering you a bonus of some free ebooks and reports. Just go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au, and you can get a copy of these reports and ebooks. Now, I'll be back again real soon, but you can catch me on social media. Just look for Michael Yardney or join our private Facebook group. Go to Facebook and look for the Property Update private Facebook group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?